Move to the next slide. I think it's important to talk about what fixed income means to an investor. So we feel that fixed income should be effectively the anchor point for any balanced portfolio. The reason being is that it sits in the middle of the risk profile, and it's very broad in terms of what you can invest in and what's defined within the fixed income universe. So effectively, advisors, some advisors define things as conservative as term deposits within their fixed income allocation. And looking at the conservative end, you can include government debt, investment grade corporates, and senior ranked in terms of capital structure, senior secured, senior unsecured corporate bonds or other types of debt. That's on the conservative side, as well as you can consider things on the lower part of the capital structure or the more riskier sub-investment grade, unrated part of the investment risk spectrum, and fixed income. You can also invest in securities such as high yield securities, hybrid securities. Some advisors define fixed income as hybrids, or lower capital structured subordinated debt. So as I mentioned before, as you move towards hybrids, subordinated debt, high yield, you're kind of moving into that riskier growth part of your book or your investment portfolio, and that sort of trends towards shares. So having a component of high yield, hybrids and subordinated debt in your portfolio together with shares provides a diversified growth part of your balanced portfolio. When you look at the more conservative side in terms of cash, having an element of government securities, term deposits, senior ranked investment grade corporate debt is more on the defensive conservative part. And obviously having an element of fixed income in that sort of space helps boost the return profile, but still maintain that conservative risk element within that portfolio. And that's the reason why we sort of mentioned that fixed income should be a starting point in terms of when you're deriving a balanced portfolio. How you move, you build up your fixed income portfolio, and then you decide what elements need to support that in terms of extra risk through shares, and obviously a higher return probability, as well as bedding down through the conservative side through cash. Moving on to the next slide, we're on slide 11 at the moment. As I sort of mentioned before, I think it's quite important to think about how you position fixed income in terms of for your clients during the different phases of the investment life cycle or the life stage investment cycle. I took a lot of this information from the MySuper ASIC website. And essentially, as you can see, moving from left to right, as you go through the accumulation phase, the pre-retirement phase, the retirement phase, you start increasing your fixed income component, or they suggest that you start increasing your fixed income exposure, because what you're trying to do in your accumulation phase is basically try and build growth within in your capital base, keep building your growth in capital base till you get to the point where you have sufficient capital to derive an income from. And as you move through pre-retirement, you want to sort of bring back some of that risk and then start thinking about what sort of capital base you have and what sort of, as I mentioned before, what sort of income you can derive from that capital base without eating into your capital too much. And then once you hit retirement, you then start thinking about what sort of mechanisms you can use in terms of how you actually draw income and how you can predict that income, and then how you can then basically manage your day-to-day expenses, because you're no longer drawing a salary, obviously, when you're retired. So while I'm talking today about fixed income SMAs, we still think that bond funds actually have a place in a lifestyle, in an investor's investment life cycle. We feel that having exposure to fixed income through a fund where income and financial objectives are not necessarily your primary objective and growth is your primary objective, having exposure through a bond fund in the accumulation phase is probably a good idea, because you don't want that income, you want that reinvestment flowing through and that growth aspects within that asset class feeding through within that phase. Once you start going to pre-retirement, you start thinking about, well, how do I start drawing an income and start planning for that? And there should be a kind of a mix between having a direct bond portfolio, which has, as I mentioned, high levels of capital preservation, defined cash flows, as well as having exposure to a bond fund to help support that growth within that asset class. But once you hit retirement, obviously, again, as I mentioned before, your financial objectives start usurping your investment objectives, and you start really thinking about, well, here's my capital base. What sort of income can I get from my investments? And that's why a lot of advisors start moving the capital or shifting the asset allocation into cash and TDs and fixed income, because they want to draw high levels of income to support their clients' day-to-day needs. Where we think a fixed income SMA works really, really well is that if you own a portfolio of bonds where you have a beneficial ownership within those bonds, you get that defined income stream coming through, and that defined income stream supports the term deposits that you have, the interest that you're earning on your term deposits, and as such, you build that income flow or income stream that the client needs for he or she to support their day-to-day spending requirements or expenses. And the next slide, slide 12, basically reinforces that idea, that reinforces those concepts that I'm trying to flesh out here. So during the accumulation phase, it's all about capital, it's all about growing capital, and probably indirect in fixed income through funds is probably the right thing to basically position your fixed income asset class exposure to. Pre-retirement phase, you're transitioning from growth to capital preservation, and therefore you're starting to move into more conservative investments and having exposure to direct fixed income versus indirect, a mix of the two, I feel is quite important. And then finally, when you're reaching retirement phase, you want to have income generative assets, and you want to maintain that capital preservation, and that's where you shift more into having a higher allocation to something like a direct fixed income portfolio. If we move on to the next slide, slide 13, I'll move quickly through this slide. What I'm trying to flesh out, there's a lot of misnomers within the fixed income market because it is an over-the-counter market. It is a very institutional market, and by over-the-counter, there's sell-side desks that basically price bonds, and there's investors which I'm a part of, that goes to these sell-side brokers or sell-side desks and asks for prices, and therefore it's very much a one-to-one relationships rather than a listed exchange where you have a centralised exchange and every investor can go in, provided they have a HIN or a CHESS account, and go and see what the prices are for certain securities in the market. But one of the misnomers is that because you've got price visibility in the listed space, doesn't always equate to liquidity. So if you look in the hybrid space, for instance, in an event where there's a sell-off, if you take January or February this year where there was, a lot of the bid side goes away in terms of and therefore in terms of volume, and sometimes the market can't support it. There's a price there as a bid offer that's listed on the exchange, but price visibility doesn't necessarily equate to liquidity. The bond universe, a lot of people think that it's a lot smaller than it actually is, because the listed bond space is quite small. If you look at listed bonds in the ASX, it's in the realm of around about $8 billion. If you include hybrids, which is circa about I think $38 billion, the total market's only about $46 billion in the corporate financial space. When you add in, we actually look at the OTC market. The OTC market's about a $1.5 trillion bond market, and if you have a bond fund that invests purely in the listed space, we feel that it's not representative of what you can get in the OTC market space. A lot of people and a lot of advisors, and this is not us drawing a line in the sand, by the way, but a lot of advisors consider hybrids because of access through the exchange, and because some of the attributes that hybrids have, that they actually classify hybrids as fixed income. hybrid is actually a preferred equity instrument, and it more trends towards equities and shares than it does towards debt. The reason being is that the coupons or the dividends that they pay, which they actually are dividends and not coupons, are non-cumulative. So in an event where someone decides, or the issuer decides not to pay a coupon or a dividend, they don't aggregate to the next dividend or coupon. And also hybrids convert to shares on the mandatory conversion date, and without the mandatory conversion date, they're actually considered a perpetual instrument. While we don't think this will happen in the Australian market, we've seen some instances in the COCO market or offshore global hybrid market more recently, such as Standard Chartered not calling their COCO security, and now it's basically in a perpetual phase at the moment, and no one knows when it's going to get called. So there are those risks associated with hybrids. Access. I think there's always a question around fixed income being an institutional market. This is provided you have the right setup in terms of having a managed account provider or broker that has a custody capacity in the fixed income space. Anyone can access fixed income, and fixed income can be invested in anywhere from $1,000 lots to the Austraclear clearinghouse minimum, which is $500,000. Having that custody capability or custody support basically allows an investor to basically build quite a diverse portfolio of bonds, even at a minimum portfolio size of $50,000 to $100,000. There's also a misnomer around fixed income being a very complex and therefore very risky asset class. It's only complex in the sense that it has defined attributes. And those defined attributes, while they may seem complex in terms of a valuation perspective, actually gives an investor more certainty. And that's the reason why it is classified as a defensive asset class.